It has begun. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, the financial system is about to get hit with a huge wave of losses as we're now seeing signs of the next credit crisis beginning, and this means the problems for the banks are only going to get worse from here on out. So bad that the former president of the Dallas Fed now is on record saying that the banks are going to have to dump assets. Let's over to Zero Hedge, where we picked today's story up with a headline: U.S. corporations filing for bankruptcy at the fastest pace since 2010. Now remember, 2010 was post-global financial crisis. So if indeed the Fed is right here and that we're heading into a no landing or maybe a soft landing, well, why we should see some bankruptcies is just natural in the system that would happen. The fact that they're rising at the fastest pace since 2010 tells us there's severe problems, because what do we look at when we see out in the broad economy, not just at the business level, but at the consumer level as well? We see a massive amount of debt. So when you see an economy slowing down at a point where it's highly indebted and companies are struggling at the margin due to high inflation and rising wages, well, next thing you know, they're headed to the bankruptcy court and things now start to look rather grim. One would not know it from looking at the S&P, which just hit a 2023 high, but there's a bit of bankruptcy crisis sweeping the U.S., where companies are filing for bankruptcy at the fastest pace in 13 years, in a clear sign of tightening credit squeeze as interest rates rise and financial markets have locked out all but the strongest borrowers. Now, this is really important to understand because, if you have a mountain of debt and you're struggling, or you're getting to the point where maybe it's just maturing and you say, hey, I need to refi it, and rates have gone up, and you go to the banks and they're saying, look, lending standards have tightened considerably here. We're not going to renew this debt. In fact, we don't want it anymore. You need to go take it somewhere else. So this fact that it's not just interest rates being up here is the issue. The bigger problem here is these companies probably cannot refinance this debt because the financial system is so tight. The increase is most visible among large companies, which we shouldn't expect to happen, where there were 236 bankruptcy filings in the first 4 months of this year, more than double 2022 levels and the fastest pace since 2010, according to S&P Global. And here you can see in this chart provided by S&P Global that we're seeing a big move higher here. Now, you'll notice it's kind of on trend for what we've seen, but that's not always the issue. As we've talked about this, sometimes it's the rate of change. When you're at a very low level, whether it's initial unemployment claims or bankruptcies. Why did we see all this? Well, we saw it because of all the pandemic stimulus. We saw it because of the monetary stimulus. All of that's being withdrawn or almost gone. And what are we starting to see? The economy slow down, bankruptcies come back up. The key part here is to where they kind of normally were, but the notable part here is just January through April. This is moving rather quickly, suggesting that by the end of the year, we could see a whole lot more bankruptcies. And it's all among types of companies, large, small. Increase in bankruptcies is somewhat more muted, though, with filing below pre-pandemic levels. But for the moment, as we've noted, however, among large unprofitable companies, they're ramping at a frenzied pace as interest rates rise. And that's the issue, is we have a lot of zombie companies. These are companies that are highly unprofitable. They're only able to exist because interest rates continue to fall. They were able to continuously refinance their debt and continuously borrow more money to stay in business. Now what we're finding out is so many of these companies are just loaded up with debt. They can't refi it. Banks don't want to touch it, and they couldn't make the interest payment if they wanted to because rates have gone up so much. The era of low interest rates and pandemic-related government support programs help keep companies afloat that may have otherwise had a few options. Now that interest rates are back to pre-Great Recession levels and pandemic support programs are largely over, we're seeing a fresh uptick and a possible sign that companies are running out of time. And again, this isn't supposed to be happening because the economy is supposed to be booming. We look at the data. What have we just recently seen? The services sector is booming. So why are companies having problems if the broad belief here is that people still have stimulus money, they want to spend it, and we're seeing it? It's because the real truth here, my friends, is the global economy, not just the U.S. economy. The global economy is slowing down here, and nobody seems to be seeing it, other than we're starting to find out in kind of these ancillary ways that problems are starting to surface. Our general view is that we're going to see an increase in hard restructurings driven by the combination of higher debt levels from the borrowing binge of COVID and rising interest rates. And there's a good key point that during the pandemic, rates went down, banks had all this money, they wanted to lend, so everyone locked in these low rates, borrowed a ton of money, and it was a really great thing. But what is a hard restructuring? Well, this is where you go to the bank and say, look, I've got all this debt. And remember, the more money you borrow from the bank, the better chance that you have of them doing something, because at that point you own the bank effectively. You know, if you owe $1,000 and you want them to do something not going to happen, you owe them $50 million. Well, they're probably going to want to talk to you, because when you go in and do a hard restructure, it means you're asking the banks to forgive part of your debt. Now, I want you to put this in broad context of what's going on with the banks now. They're already hemorrhaging from all the deposit outflow. And next thing you know, you're going to see all of these borrowers come in the door and say, look, we owe you a ton of money. Your choice is we can default and walk away, or you can give us a haircut so we can new loans so we can stay in business. And this is going to be a challenge because you see, financial conditions here. This is in terms of tightening standards for loans across the entire commercial industrial space in blue. And what I noted here, I wanted to put on here commercial industrial loans. Now, we've recently looked at it on a year-over-year rate of change, but now we're going to look at it on a month-to-month change in just billions of dollars. And what I want you to see is that lending tends to fall at some point, not only as we hit a recession, which is this gray bar, but as financial conditions tighten, where the blue line goes above that horizontal black line. And notably, look, you kind of start to see this kind of late recession show up, and now we're starting to see it, what would arguably early recession, if the data even shows that we're actually headed into a recession. What do you think? Do you think we're in a recession today? Do you think we're in the early stages? Maybe we're in the late stages and no one just realized it yet. Where do you think we're at? Weigh in the comments. Would love to hear. Because the problems that I suggested in the intro is the bank bailout facility. Problems for the banks are going to get worse. We see the usage now hits new record high as money fund inflow soared against last week. And one thing that should be hitting new highs right now is your trading account, because as we talked about recently, you can see this move in the NASDAQ showing here the ETF QQQ. Our CTA-Timer Pro told you to buy right here. It started to give you those early signals. And if you missed it, it said, hey, you've got a second chance at it. This thing's shooting to new highs this year. You got to be in on it. This is only $30 a month. Here you can see from the January 9th report, it started to show the machines were short covering. The first indicator that you should be starting to build positions there after a major short move to the downside. And here you see it again on March 15th. The machines were back buying. Again, $30 a month, risk-free, 30-day money back guarantee, gives you the signals almost faster than anything else you've seen. It is a phenomenal report. Check it out, and it'll change the way you trade. The last few days have seen exuberance fade in regional bank shares, as tonight's money fund flows data is certainly not going to help things at all, as inflow soared by the most since last week, up $47 billion to a new record high of $5.39 trillion. So here you see the next problem. We talk about the problems for banks. This isn't the next problem. This is the original problem that the Fed's trying to deal with. And we told you there would be no way the Fed would stop this. What have we seen? An increase of money flowing into money markets. Again, making the problem for banks here even worse, as they now potentially, again, face these bankruptcies where they're going to have to go in and give these companies haircuts to stay alive. And yet we turn to former president of the Dallas Fed, Robert Kaplan, in a mind-blowing interview where his warnings on inflation and QE were early and right. Well, let's worry. What is he worried about now? As he says, we're now heading into the third phase as bank leadership at small and mid-sized banks are considering how to shrink their loan books in order to address the market loss of capital. So think about this. You've got your assets, the loans, your liabilities, deposits. As the liabilities leave and go to money markets, what happens? You have a mismatch. So what does that mean? You either need to get some more liabilities, get some money flowing back into your bank, which appears to not be happening, or you start having to shed those assets, and guess what? They're all upside down. So you're going to face a hard decision of taking a loss. And what he's suggesting is they're going to have to do this against potential deposit instability, as bank leadership is aware that the economy is slowing and we're likely about to enter a challenging credit environment. So it blows me away that he's just admitting, look, there's a problem here and it's not going to get any better. And while the asset liability mismatches are relatively easy to spot, well, because all the banks have them, assessing the quality of loan portfolio is much more complicated. The CEOs of many of these banks are in a tough position. They can't easily raise equity because, well, their stocks are plummeting and nobody wants to buy it and no one's confident in it. And as a result, they're turning to shrinking their loan books, forcing them to take losses and finding places to pull back on existing loans and future commitments. This is making it much harder for small, mid-sized businesses, as I said earlier, to get and keep their bank loans, hence why we're seeing this increase in bankruptcy filings. It starts to all come full circle here. Banks can't lend, companies need money. Next thing you know, you see bankruptcies coming in and the banks get hammered either way. It's a lose-lose proposition here for the banks. It's a quiet phase that won't make headlines, but is nevertheless relentlessly going on beneath the surface. And here we can see the bank problems are not getting any better. We see Bank Term Funding Program. This is where you take your assets to the Fed and get cash. Well, now at an all-time high in usage. We see other credit extensions coming down a little bit as banks go to long-term solutions. You remember this, Fed program is up to a year in length where you take your securities, those unrealized losses, you give them to the Fed and you get cash. So the problem is the banks aren't seeing a solution here. They're not seeing things get any better. They're taking a long-term risk here on this program that the Fed has when we know the ultimate solution, the end of the day, the Fed will be forced back to zero. I know many people don't believe me, but look at the problem and look what the Fed will see as a solution is. You have unrealized losses. We're headed to a recession. Well, we'll go back to zero because some of the moves these banks are making now don't make any sense. But all the banks did see some inflows last week, saw money coming into them as small banks saw about $6 billion and deposits increased about $32.9 billion across the board from large, small, and foreign banks. But what do we know? But small banks were big lenders last week. Now, this is interesting. They were big lenders in the real estate space. So you talk about potentially prices being near a high, heading into a recession. We know that real estate prices come down, and lo and behold, what are the small banks doing? They're out lending against high valued assets. Now, what do you think? Do you think real estate prices come down this time? Do you think the banks are making a smart move? Or do you think this is just another nail in the coffin of what will be a whole string of bank failures? Weigh in the comments. Would love to hear from you. Because Janet Yellen is back now saying the debt limit talks get more time as U.S. Treasury pushes back deadline. Now, I want you to see this little politicking going on here because we know Janet Yellen, former Fed chair, now is this Treasury secretary hired on by President Joe Biden. We know he's a Democrat. And what have we been hearing from Janet Yellen? We're going to run out of money. We're going to run out of money. We're going to run out of money. We better get this done because we're running out of money. And all of a sudden it's like, oh, the deal's almost done. Oh, wait, look, we have a few extra days of money now. And, you can just see the politics being played here at every level. Janet Yellen not immune to what her boss needs to try to force a deal through. Looks to be done soon, though. But she announced the department now expects to be able to make payments on U.S. debts up to June 5th if lawmakers fail to act. And all of a sudden, we now have that little more time that we need after the holiday, then set a more pointed date for potential default, but is also 4 days later than her previous comments of June 1st. And looking back toward a show we did the other day, the German growth outlook deteriorates, this being a follow-up as German companies aren't seeing any evidence of pickup taking hold in Europe's biggest economy. You remember, think back, what did we hear from the experts? They said, look, we think the worst is behind us now. We think the economy turns around. But look at this. Again, the survey here says that no way this economy is not rebounding. The group maintained a prediction of zero growth in 2023, an outlook that's more pessimistic than the expansion forecast by the European Commission and far more optimistic than what I would give. And my thought is we're headed into a much deeper recession. Germany is only one of the first indicators that things are about to get a whole lot worse. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.